Okay, welcome to the deep dive. Today we're tackling a really fascinating company, one that's kind of hiding in plain sight, the Middleby Corporation, NASDAQ Q ticker MIDD.
Yeah, they're this sprawling industrial giant. You might not know the corporate name, but chances are you've eaten food prepared or processed using their equipment.
Absolutely. They design and manufacture equipment for, well, basically the entire food ecosystem. We're talking everything from huge industrial meat processors
Mm.
down to your local drive-through.
And even, believe it or not, into ultra-luxury home kitchens. It's quite the mix.
It really is. And the scale is just staggering. What are the numbers? Over 120 brands?
That's right. Over 120 specialized brands, something like 11,000 employees across the globe. And for fiscal 2024, they pulled in $3.88 billion in net sales.
Wow. $3.88 billion.
Right.
So definitely not small potatoes.
Not at all. They're really fundamental to how the global food industry actually operates.
Okay, so let's get into our mission for today's deep dive. We're focusing on a massive shift happening at Middleby right now. It's not just some minor tweak.
No, this is major surgery. They're planning to break up the company. Specifically, they're separating their food processing equipment group.
Spinning it off into a whole new standalone public company. They're aiming to get that done by, what, early 2026?
Correct. Early 2026 is the target. And it's really a direct response to this complexity we've been talking about.
Yeah, management itself basically admitted that this super diversified structure, serving fast food joints, wealthy homeowners, and industrial factories, has created a problem.
Exactly. They've acknowledged what analysts call the conglomerate discount. The idea is the market just can't properly value all these different pieces when they're jammed together.
So the sum of the parts is potentially worth more than the whole. Is that the thinking?
That's the bet. So today we're going to unpack that original structure, dig into the big trends driving the business, and really scrutinize the plan for this breakup. Will it actually unlock the value they hope? That's the key question.
All right, so let's start with the before picture. Understanding the conglomerate they built, this beast they're now trying to, well, break apart.
It really operates in three incredibly distinct economic spheres, and the revenue breakdown tells you a lot about where the real power lies.
Okay, lay it out for us.
Well, the absolute foundation, the real cash cow, is the commercial food service equipment group. In 2024, that segment generated $2.42 billion.
$2.42 billion out of the 3.88 total.
Yep, that's 62.4% of total sales. This is their core engine where they've really established their dominance.
Okay, dominant core. Then you got the other two segments, and it's kind of funny. They're almost the same size revenue-wise, but they serve totally different people.
Exactly. You have the food processing equipment group. That's the one being spun off. That was $731 million, about 18.9% of sales.
Industrial scale stuff.
And then almost identical revenue, $724.9 million, or 18.7% of sales, comes from the residential kitchen equipment group. This is pure luxury. High-end home appliances.
It's just wild to think about. The same company selling like a massive automated sausage stuffer and a $30,000 handcrafted French oven.
That's the cognitive dissonance right there. And that's what analysts point to when they talk about that discount. The market scratches its head.
So let's make these segments a bit more concrete.
Yeah.
Who are the actual customers for each? Start with commercial.
Okay, commercial food service. This is all about high volume, high throughput. Think global fast food chains, your McDonald's, your Yum. Brands plus fast casual places, big hotel chains, hospitals, universities, prisons even.
Anywhere serving lots of meals fast.
Exactly. Their priorities are speed, consistency, reliability, fitting into tight kitchen spaces, and increasingly energy efficiency. And the brands here are legendary in the industry.
Right.
Middleby Marshall, famous for conveyor ovens, think pizza places.
Mm.
Turbo Chef, which is a game changer in speed cooking. You can cook things incredibly fast.
Right, I've seen those.
Blodgett convection ovens, another workhorse.
Oh, what?
And a really critical one, Taylor. They make the soft-serve ice cream machines and frozen drink dispensers you see everywhere. Huge, reliable revenue stream.
So cooking, cooling, holding food, dispensing drinks, basically the whole kitchen line.
Pretty much. They aim to provide that full-line solution.
Okay, now pivot completely. Residential. Who's buying a Viking range or a Le Cornu?
Totally different world. This isn't about throughput, it's about aspiration, design status. The customers are high net worth individuals, people doing expensive custom home builds, architects designing luxury spaces.
The focus is aesthetics, brand heritage.
Exactly. And performance that mimics professional kitchens. That whole prosumer trend, people wanting commercial-grade stuff at home. Think Viking range. Instantly recognizable.
Yeah.
Le Cornu, which are these stunning, often custom-made ranges from France. Real statement pieces. AGA ranges, those classic cast-iron British icons.
And outdoor kitchens, too.
Oh yeah, big time. Brands like Lynx for high-end outdoor grills and kitchens. The buying decision here is driven by design trends, kitchen designers, luxury budgets. Nothing like the ROI calculation for a QSR chain.
Okay, world number 3, the one getting spun off. Food processing equipment. Pure B2B industrial.
Pure industrial. Their customers are massive food manufacturers. We're talking industrial-scale protein processors, companies making tons of bacon, sausage, chicken products, also large commercial bakeries, snack food giants.
And they're not buying just one machine, right?
No, they're buying integrated systems, often highly customized end-to-end production lines. These systems handle everything from initial prep, grinding, mixing, then thermal processing, cooking, smoking, chilling, then slicing, dicing, and finally high-speed automated packaging.
Gotcha. So whole lines, any key brands there?
Sure, Alcar is a big name in thermal processing, like industrial smokehouses. Rapid Pack is known for sophisticated high-speed packaging solutions. The whole conversation here is different. It's about maximizing yield, ensuring uptime 24/7, traceability for food safety, meeting regulations.
So you've got industrial engineers, restaurant managers, and interior designers all buying from Middleby. How on earth did they stitch together this incredibly diverse portfolio, 120-plus brands? It must have been deliberate.
Oh, absolutely deliberate. And it really boils down to two key strategies they executed consistently for decades. The first one is acquisition-led growth.
M&A.
They bought their way to this scale.
In large part, yes. Middleby has been a very disciplined, very strategic consolidator in the industry. They systematically identify and acquire smaller companies, often family-owned businesses, that have developed some unique or superior technology.
Filling gaps in their own lineup.
Precisely. The goal is always to build out that full-line solution capability. The biggest global customers, like those QSR chains, they want to deal with fewer suppliers. Middleby acquiring brands allows them to offer that integrated package.
And that strategy was still active right up until the spin-off announcement, right? There were those two acquisitions in August 2025.
Yeah, fascinating timing, wasn't it? They bought Frigo Meccanica S.p.A. and Oka Special Machine and Fabric, GmbH & Co. KG. Tell us about those. What do they signal?
Well, Frigo Meccanica is Italian. They specialize in high-end refrigerated display cases and storage, the kind you might see in upscale supermarkets or commercial kitchens. It likely strengthens their cold side capabilities, especially for food prep areas.
Okay. And Oka, German name.
German, yes. Oka Spezial Machine and Fabric makes specialized equipment for dough processing and baking. Think industrial bakeries.
So buying these just before announcing the spin-off of the food processing segment seems pointed.
Highly pointed. I think it serves two purposes. One, it demonstrates they're committed to maximizing the value and technological depth of the food processing business right before they set it free, making it even more attractive.
Bolstering it for the IPO, essentially.
Exactly. And two, it ensures that the new SpinCo isn't just some leftover division. It starts life as a more complete, technologically advanced player in its specific markets. They're launching a contender, not an afterthought.
Makes sense. Dress it up before you take it public. Okay, so M&A was pillar one. What's the second pillar of their historical success?
Pillar two is innovation and solution selling. They're not just order takers. They proactively develop solutions, particularly around automation, which we'll get into. Things like ventless cooking tech, crucial for kitchens with limited space or no traditional hoods.
Right. Saves huge installation costs.
And connectivity is becoming huge, too. Their open kitchen platform uses IoT to connect equipment, allowing for remote monitoring, predictive maintenance, data analysis.
But the real showpiece of this strategy seems to be these innovation kitchens. The mix.
Ah, yes, the Middleby Innovation Kitchens. They have major ones in Dallas, Texas, and another in Germany. These are incredibly powerful assets.
Explain why. What happens there?
Think of them as state-of-the-art culinary labs combined with showrooms. A huge potential customer, say a global hotel chain or a big QSR, can bring their chefs, their operations people, their engineers.
And basically test drive a whole kitchen.
Exactly. They can set up an entire integrated kitchen using equipment from across Middleby's 120 brands, simulating their actual operating environment. They can develop new menu items, test cooking times with the latest turbo chef ovens, figure out staffing needs, quantify energy savings.
All before they spend millions on rolling it out globally.
Precisely. It's a consultative selling approach. They co-develop the solution with the customer. This builds incredibly deep, sticky relationships. It's not just about selling a machine, it's about solving a business problem, and it's a massive competitive advantage.
Plus, they can demonstrate the whole connectivity piece there too, right? The open kitchen platform in action.
For sure. They can show how data from fryers, ovens, coolers across, say, 1,000 hypothetical locations can all be tracked and managed centrally. It makes the benefits of IoT tangible.
Okay, so they built this empire through smart acquisitions and a very sophisticated, solution-focused sales approach, leveraging these mix. Successful, clearly, given the revenue, but also complex. And maybe that complexity eventually became the problem.
That seems to be the conclusion management reached. Which brings us to the market forces at play and this surprisingly unifying theme of automation that cuts across these very different segments.
Right, so to understand why they're breaking up, we need to look at the underlying dynamics in each market. And you're saying there's a common thread.
A very powerful common thread. Despite how different the end customers are, the underlying need driving capital spending is increasingly similar. Let's start with the biggest piece, commercial food service equipment.
Okay, the core engine. How big is that market globally?
Estimates vary, but it's somewhere in the range of $35 billion to $43 billion. And it sees pretty steady growth, maybe 5% to 6.3% compound annual growth rate, typically.
What usually drives that growth?
Well, the traditional drivers are things like the global expansion of QSR chains, particularly into developing economies. General consumer spending on eating out is a factor. And recently, new models like cloud kitchens or ghost kitchens delivery-only outlets create demand for efficient equipment in small spaces.
But you mentioned a bigger, more structural driver now.
Yes. The overwhelming, non-negotiable driver today is the labor situation. Chronic shortages of kitchen staff, coupled with relentlessly rising minimum wages in many parts of the world.
Ah, okay. So equipment becomes the solution to a people problem.
Precisely. It fundamentally changes the math for restaurant owners and operators. It used to be labor was relatively cheap, equipment was a big capital cost. Now, investing in automation isn't just about expanding, it's often about survival. It's a productivity necessity.
Give us an example.
Think about automated fry stations, machines that can automatically lower baskets, monitor cooking time and temperature, even filter the oil themselves. That might eliminate the need for a dedicated fry cook, or allow one person to manage multiple stations safely.
Or those super fast ovens you mentioned. Turbo Chef.
Exactly. If you can cook a sandwich or protein in, say, 90 seconds instead of 5 minutes, one employee can handle significantly more orders during peak times. The ROI calculation becomes very clear. Does this machine save me X amount in labor costs per year?
And that makes the purchase less discretionary, less tied to the economic cycle.
That's the argument. If the equipment directly offsets persistent labor costs, the purchase becomes much more defensive than, say, buying equipment just to open a new location. It protects existing margins.
Makes sense. What other key trends are big in commercial food service?
Energy efficiency is huge. Restaurant utility bills are massive. Equipment that uses less gas or electricity, often carrying an Energy Star certification, is highly desirable. It's another operational cost saving.
Constant pressure to innovate there, then.
Absolutely. And as we touched on, connectivity IoT via platforms like Open Kitchen. The ability for chains to remotely monitor equipment performance, energy usage, predict maintenance needs across hundreds or thousands of locations, that's becoming table stakes for the big players.
Okay. Now let's switch gears to the heavy industry side, the food processing market. This is the segment getting spun off. How big is this one?
This is another massive market. Estimates range from $48 billion up to maybe $70 billion globally. It's always been more automated than food service, obviously.
But the pace of change is picking up here too. Why?
It's that same labor issue, hitting manufacturing floors hard. It's incredibly difficult to find and retain workers for repetitive, sometimes physically demanding jobs on processing lines.
So automation fills the gaps.
Yes, but it's more than just labor savings here. It's also driven by increasingly strict food safety regulations and the need for traceability.
Ah, right. Knowing exactly where every ingredient came from and what happened to it.
Precisely. You simply cannot achieve the level of tracking and documentation required today without highly automated systems. Robots, sensors, AI monitoring the line, they minimize human handling errors, ensure consistency, reduce contamination risks, and crucially, provide the detailed digital records regulators demand.
So automation is critical for compliance and quality control, not just efficiency.
Absolutely. It's about yield optimization too, making sure every pound of raw material results in the maximum possible finished product. So the big trends here are advanced automation, robotics, sophisticated slicing and packaging systems, and the software to manage it all.
And automated equipment is already dominant.
Yes, data suggests automated equipment already made up over half the market share back in 2023, and that trend is only accelerating. The Spinco will be a pure play investment in this industrial digitization wave.
Okay, finally, the outlier. The residential market. Luxury appliances. How does automation or efficiency play in here? It seems more about looks.
It's definitely different, but there are connections. The overall market is enormous, estimated at $243 billion to $279 billion globally, tied heavily to housing starts and remodeling cycles.
So more cyclical.
Generally, yes, but the type of product in demand is shifting. You mentioned the prosumer trend. People watch cooking shows, they see chefs using high-performance gear.
And they want that power and precision in their own homes.
Exactly. They want ranges with high BTU burners like a restaurant, ovens with precise temperature control, maybe even features like steam injection or sous vide capabilities built in.
Yeah.
So brands like Viking, Wolf, Le Cornu cater to this demand for professional grade performance, even if it's not strictly needed for home cooking.
So the technology is still advanced, even if the driver isn't labor-saving?
Correct. And the other big piece is smart home integration. Wealthy consumers expect their $15,000 refrigerator or oven to connect to their network, to be controllable via apps or voice assistants like Alexa or Google Assistant.
Right, everything's connected.
So while it's not driven by the same urgent labor pressures as commercial or processing, there's still significant R&D needed in electronics, software, and connectivity to meet the demands of the luxury market. They have to be tech-forward, not just beautiful.
Okay, so let's tie this all together. We've got these three very different markets. QSRs needing labor savings, factories needing traceability and yield, luxury homes wanting pro features and connectivity. What's the aha moment? What's the fundamental connection that Middleby exploited?
The unifying force, the really durable trend, is the fundamental need to boost productivity and efficiency in the face of structural cost pressures, primarily labor, but also energy and regulatory compliance.
It's a defensive imperative.
Exactly. It's defensive. In large parts of their business, particularly commercial and processing, the demand for their equipment isn't just about growth or expansion. It's about replacing recurring operational costs, especially labor, with a one-time capital investment that has a clear, often rapid payback.
And that makes the demand stickier, less vulnerable in a downturn.
That's the critical insight. Think about it. If a recession hits, a restaurant chain might pause plans to build 10 new stores. That hurts companies selling equipment purely for expansion.
Right.
But if that same chain can install automated systems in its existing 500 stores and demonstrably cut labor costs by, say, $30,000 per store per year, that investment looks incredibly attractive, even essential to protect profitability during tough times. The ROI is immediate and compelling.
So the replacement cycle, driven by automation and efficiency, is more resilient.
We believe so. Plus, Middleby benefits internally from this structure, even if the market doesn't value it. Technology developed for, say, high-efficiency thermal systems in their industrial food processing ovens can potentially be adapted and scaled down for their commercial speed ovens.
Cross-pollination of R&D.
Yeah, creating technological advantages that pure-play competitors might struggle to match quickly. So this underlying defensive demand for productivity is the real jewel in Middleby's crown, even if the conglomerate structure made it hard for investors to see clearly.
Okay, so there's this strong underlying defensive demand driven by automation. But looking at Middleby's recent financials, it doesn't seem like that's fully insulating them right now. The numbers suggest they're definitely feeling some pain.
That's true. The top-line performance recently indicates that the cyclical headwinds, particularly in the U.S. market, have been strong enough to temporarily overshadow those secular tailwinds. They appear to be in a bit of a cyclical trough.
What did the numbers show for fiscal 2024?
For the full year 2024, total net sales actually decreased to $3.88 billion. Organically, meaning stripping out acquisitions and currency effects, sales declined by 4.7%.
Ouch. And the reasons?
Management pointed mainly to slower conditions in the domestic market, and particularly some large QSR chain customers becoming more cautious and delaying big equipment rollouts, holding back on CapEx.
And that weakness continued into this year, 2025.
It did. In the second quarter of 2025, the overall organic sales decline was 5.4%, and it was pretty broad-based across the segments.
How did the individual segments fare in Q2?
Commercial food service, the core engine, was down 5.5% organically. Residential, which you'd expect to be sensitive to housing and interest rates, fell 7.8% organically.
And even food processing.
Even food processing, which is sometimes seen as a bit more stable due to longer project cycles, was down 2.9% organically in Q2. So yeah, definitely facing a challenging macro environment across the board.
Okay, so top line is shrinking. But you mentioned a paradox earlier. Despite falling sales, their operational strength is holding up.
This is the really crucial part, and it speaks volumes about the quality of the underlying business, especially the core. Despite those sales declines, look at the margins. Gross margin was remarkably stable, 37.9% in 2024, and actually ticked up slightly to 38.0% in Q2 2025.
Holding steady on gross profit even as sales fall. That implies strong pricing power or cost control.
Exactly. They're managing input costs well and seemingly able to hold prices relatively firm. But the truly eye-popping number is the profitability within the commercial food service segment.
Let's hear it.
In Q2 2025, even with sales falling 5.5%, the commercial food service segment delivered an adjusted EBITDA margin of 27.0%.
27% for industrial manufacturing.
It's an elite number, truly elite. Many good industrial companies operate in the 15 to 20% adjusted EBITDA margin range. Hitting 27%, especially during a downturn, signals incredible strength.
What does that tell you?
It says they have significant pricing power, probably stemming from proprietary technology like Turbo Chef speed cooking or the essential nature of tailored dispensers that customers need and are willing to pay up for. It also suggests very disciplined cost management within that division.
So this 27% margin machine was kind of hidden or diluted by the lower margins or cyclicality of the other segments in the overall conglomerate view.
That's precisely the argument for the breakup. The market wasn't giving them full credit for this highly profitable core because it was lumped in with everything else. And this underlying strength also shows up in their cash generation.
Right, cash flow. How's that looking?
Fantastic, actually. For the full fiscal year 2024, they generated a record $687 million in operating cash flow. That's serious cash generation, confirming that profitability and efficiency aren't just accounting metrics.
And that strong cash flow gives them options.
Huge options. It's what funds their ability to return capital to shareholders, which we'll get to, and it's fundamental to being able to structure the spin-off financially. But because this operational excellence wasn't translating into the share price they felt they deserved...
Enter the activists and the decision to split.
Exactly. The food processing spinoff, announced February 25, 2025, is the direct strategic response to that conglomerate discount and the desire to unlock that perceived hidden value.
So let's get into the specifics. How is this separation actually going to work?
The plan is for a tax-free spinoff. This means existing Middleby shareholders will receive shares in the new independent food processing company proportional to their current Middleby holdings. They'll end up owning shares in two separate companies instead of one.
And the goal? Two pure plays.
Two pure play companies, each with a clearer story for investors, each able to tailor its capital structure and strategy to its specific market, and hopefully each attracting a more appropriate valuation from investors who specialize in either commercial, residential, or industrial processing. Completion target, early 2026.
Okay, let's look at the estimated profiles of these two new entities based on 2024 numbers. What does Middleby RemainCo look like?
So Middleby RemainCo keeps the big commercial food service engine and the residential kitchen group. Based on 2024 figures, that would be roughly $3.1 billion in annual revenue.
And the profitability? Still strong.
Very strong. Projected adjusted EBITDA margin around 23%, still a high-quality, high-margin business.
Okay. And the new company, the food processing SpinCo?
SpinCo will be smaller, obviously. Around $700 million, maybe a bit more, in annual revenue based on 2024. But look at its projected margin.
Higher than RemainCo.
Even higher. Projected adjusted EBITDA margin around 26%. Very lean, very focused, very profitable industrial technology business.
So on paper, you create two distinct, highly profitable companies. Seems like a win-win. But spinoffs aren't simple. What about the debt? How do they split the liabilities?
That's always one of the trickiest parts. Where does the existing corporate debt land?
The general expectation, and the most logical structure, is that RemainCo, the larger entity with the super stable commercial food service cash flows, will retain the vast majority of the current debt.
Because it has the reliable cash flow to service it.
Exactly. Its cash generation profile can support higher leverage. The new SpinCo, on the other hand, will likely be launched with a much cleaner balance sheet, maybe very little debt or even none initially.
Why do that?
To give it maximum financial flexibility right out of the gate, it needs to be able to invest in R&D, potentially make bolt-on acquisitions in its specialized industrial space, and compete effectively without being burdened by heavy interest payments. A clean balance sheet makes it much more agile.
Okay, debt allocation is key. What about the overhead costs? The stuff the conglomerate shared, like HR, IT, legal. SpinCo needs all that itself now. That's the other major execution challenge. Dyssynergies, or the cost of creating duplicate corporate structures. SpinCo has to build out its own C-suite, its own finance department, IT systems, public company reporting function.
Which costs money.
Absolutely. There will inevitably be transitional costs and potentially a higher ongoing general and administrative G&A expense burden for SpinCo compared to when it was part of the larger Middleby structure. Analysts often estimate this could initially be a drag of maybe 100 to 200 basis points on that projected 26% margin.
So that 26% might be closer to 24, 25% in the first year or two.
Potentially, yes.
Yeah.
Management's challenge is to make that transition as lean and efficient as possible, minimizing those stranded costs in RemainCo and getting SpinCo to scale quickly. The market will definitely be watching G&A closely post-spin.
Okay, so internal execution risks around debt and costs. Now let's talk about a huge external challenge they're grappling with right now. Those tariffs.
Yeah, this is a really significant near-term headwind. New tariffs imposed in 2025 are hitting them hard. Management estimates the total annualized cost impact at $150 million.
Wow, $150 million
Yeah.
just from tariffs. How much is that relative to their earnings?
It's huge. To put it in perspective, $150 million is nearly 4% of their total 2024 revenue. It's a direct hit to profitability. They already saw a net negative impact of about $10 million on EBITDA in Q2 2025 alone.
Okay, that's a serious problem. What's their plan to deal with it?
Management has publicly stated they're confident they can offset this entire $150 million hit by fiscal year 2026. Their strategy has two main components.
Sure.
First, pricing actions, basically raising prices to pass the tariff costs on to customers. Second, leveraging that global manufacturing footprint, shifting production and sourcing.
Okay, let's take pricing first. They're already seeing negative organic growth. Customers are cautious. Can they really push through significant price hikes right now without losing more volume? Seems risky.
That is absolutely the tightrope they have to walk. It's the key point of skepticism for many analysts. Their bet has to be that their equipment, particularly the automation-focused, labor-saving kind, is essential enough, provides enough ROI that customers will ultimately swallow the price increase.
Banking on that defensive demand we talked about.
Exactly. They're betting the value proposition is strong enough to withstand it. The second lever, global footprint, is about supply chain optimization.
Meaning?
It means aggressively moving sourcing of components or even final assembly away from countries where the tariffs originate, China being the obvious one. They might shift production to existing plants in Mexico or Europe or find new suppliers in non-tariff regions.
That sounds complicated and expensive itself.
It's a massive logistical undertaking. Reconfiguring global supply chains takes time, investment, and carries its own execution risks. But if they can successfully shift enough production and sourcing, they can mitigate a significant chunk of that $150 million tariff burden.
So their ability to actually deliver on offsetting that $150 million is pretty critical to the investment case right now.
Absolutely critical. If they fall short, it significantly impacts the underlying earnings power of both RemainCo and SpinCo, right as they're trying to convince the market of their standalone value.
Okay, so just to recap this part.
Yeah.
They're managing a complex spinoff, dealing with setting up new cost structures, allocating debt, and simultaneously trying to navigate a $150 million tariff bomb through pricing and global restructuring. That's a lot for management to juggle.
It demands incredible focus and execution discipline, no question about it.
All right, so assuming they navigate the spinoff and the tariffs successfully, let's look at the long-term picture for these two new companies. What makes Middleby or its future parts hard to compete with? What's their competitive moat?
There are several layers to it. The first, which we touched on, is simply the brand breadth and integration. Having 120-plus brands covering nearly every category in commercial kitchens allows them to be that one-stop shop.
Which big customers value?
Hugely. Large global chains want simplicity. Dealing with one primary supplier for ovens, fryers, coolers, beverage systems simplifies procurement, training, servicing, everything. It's a significant advantage.
Okay, breadth is one. What else?
The distribution and service network is massive. To serve global QSRs, you need feet on the ground everywhere. If a critical piece of equipment goes down in Singapore or São Paulo, you need qualified technicians and parts available fast. Building that global infrastructure takes decades and an enormous investment. It's a huge barrier to entry.
Right, you can't just start that overnight.
Definitely not. And then there's the technological leadership in key areas. We keep coming back to things like TurboChef's speed cooking patents or their innovations in ventless cooking systems. These aren't just nice features. They directly address the core constraints of labor costs and limited kitchen space, especially in expensive urban locations. That tech differentiation creates a powerful moat.
Okay, strong moat. But they do have serious competition, especially in that core commercial food service segment. Let's talk about Illinois Toolworks ITW.
Ah, yes. ITW is definitely Middleby's most formidable competitor in commercial food service. Their food equipment segment is a powerhouse.
What brands do they have?
Really iconic, well-respected names. Hobart is probably the most famous. Think mixers, slicers, dishwashers, known for being absolute workhorses, incredibly durable. And Vulcan ranges and ovens are also industry standards.
And financially, how do they stack up against Middleby's commercial segment?
Very closely, actually. ITW's food equipment segment did about $2.6 billion in revenue in 2024, so slightly larger than Middleby's commercial segment alone. And their operating margin was also impressive, around 27%, right in line with Middleby's 27% adjusted EBITDA. Elite profitability for both.
So similar size, similar profitability. You mentioned their strategies are different.
Radically different in terms of philosophy. It's a fascinating contrast.
Explain that. Middleby versus ITW strategy.
Middleby, as we discussed, uses M&A to achieve system integration and breadth. They want to sell you the entire connected kitchen solution, often leveraging those mix to customize it. Their strength is the total package.
Okay.
Yeah.
And ITW.
ITW operates very differently, guided by their famous 80-20 business process. They focus relentlessly on product-level excellence within specific, high-value niches. They aim to make the absolute best, most reliable mixer or the most efficient dishwasher on the market. Their strength is deep brand-specific loyalty and recognized superiority in individual product categories.
So Middleby sells the system, ITW sells the best-in-class individual components.
That's a good way to put it. A large customer might choose Middleby for the overall kitchen package and integration, but they might still insist on specifying a Hobart mixer within that package because of Hobart's unmatched reputation for that specific task.
Interesting. So Middleby's moat is the integrated solution.
Yeah.
ITW's is product perfection and brand reputation in specific areas.
Exactly. They compete fiercely, but they often win on different value propositions. And frankly, the market needs both approaches. It validates the high margins both companies achieve.
Okay. Shifting from competition to internal dynamics. We mentioned activist influence. The arrival of Ed Garden from Tryon Fund Management on the board, simultaneous with the spin-off announcement. That wasn't a coincidence.
Not at all. Tryon is a well-known activist fund. Their involvement, culminating in a board seat for Mr. Garden right when the breakup strategy was unveiled, strongly signals that shareholder pressure was a major catalyst for this strategic shift.
So the spin-off wasn't just management deciding it was a good idea. It was likely pushed, or at least heavily encouraged, by shareholders wanting to unlock that value faster.
That seems highly probable, and it signifies a really fundamental change in Middleby's capital allocation priorities.
How so?
For decades, Middleby's story was growth through M&A. They used their cash flow to buy other companies. Now the focus has pivoted sharply away from acquisitions towards direct shareholder returns.
Primarily through buybacks.
Aggressively so. The numbers are stark. Through July 2025, Middleby had already repurchased $448.9 million worth of its own stock.
Wow. How much of the company is that?
That's about a 5.7% reduction in the total shares outstanding in just over half a year. And they've guided for more.
That's the target.
Management has stated they intend to use the vast majority of annual free cash flow towards repurchases, aiming to shrink the share count by a significant 6% to 8% per year.
That's a massive buyback program. It's management basically screaming they think the stock is cheap.
It's the clearest signal possible. They believe the market is undervaluing the company, and they're using their strong cash flow to buy back shares at what they consider a discount, directly boosting earnings per share for the remaining shareholders. course. It's a classic activist influence playbook.
But does it make long-term strategic sense? Middleby built itself through M&A. Is abandoning that core competency for buybacks the right move, or just a short-term fix to appease Tryon and boost the stock price?
That is the billion-dollar question, isn't it? The argument for it is that M&A multiples are high right now, maybe acquisition targets are too expensive. So returning cash via buybacks is a more efficient use of capital in the current environment. Focus organically, clean up the structure.
And the argument against?
The argument against is that M&A is Middleby's DNA. It's how they acquire technology and breadth. Stepping away from that could risk slowing down innovation and falling behind technologically in the long run, especially once the initial valuation bump from the spinoff wears off. They're fundamentally betting that focus and financial discipline will create more value now than continued diversification through acquisition. Time will tell.
Okay, let's bring this all back to valuation. Why, despite the 27% core margin, strong cash flow, and massive buybacks, does this conglomerate discount still seem to exist?
Because the market is still pricing in the complexity, the execution risk of the spinoff, the cyclical nature of parts of the business, especially residential, and crucially, the uncertainty around that $150 million tariff impact.
So what's the actual valuation multiple look like now?
Right now, Middleby is trading at a trailing 12-month price-to-earnings ratio of around 16.8 times.
And how does that compare to, say, ITW?
Significantly lower. ITW, its closest pure-play comp in the core business, trades around 22.9 times trailing earnings. That gap, roughly 6 points on the PE multiple, is essentially the market's quantification of the conglomerate discount and the associated risks.
So the current price reflects the messy reality, but maybe not the potential value of the cleaned-up pieces.
That's the core investment thesis here. The current valuation seems to fully price in the cyclicality and the execution challenges. But it arguably does not give full credit to that resilient 27% margin in the core commercial segment, nor does it seem to assign a proper premium industrial multiple to the high-margin food processing business because it's still mixed up with Viking ranges.
The bet is that the separation forces the market to reevaluate.
Exactly. Once there are two distinct tickers, investors specializing in industrial tech will value Spinco against its peers, and investors focused on commercial food service and perhaps consumer durables will value Remainco against its peers. Management is betting heavily that the sum of those two separate valuations will be significantly higher than the current combined valuation. The entire strategy hinges on that re-rating post-spin. Hashtag outro. So wrapping this up, what we've seen is the Middleby Corporation undertaking a really fundamental transformation. They're moving decisively away from being this complex, diversified conglomerate that the market struggled to understand.
And penalized with that discount.
Right. Towards creating two leaner, focused, pure-play companies, each a leader in its respective field. And the underlying strategic logic seems solid, tapping into that undeniable global long-term need for automation driven by labor costs and efficiency pressures.
Yeah, that defensive demand seems real. But the path forward isn't exactly smooth. There are some major hurdles in the immediate future.
Definitely. The key risks are clear. First, just the sheer execution risk of pulling off this complex, tax-free spinoff, smoothly hitting the timelines, managing the costs, allocating debt correctly.
Second, the tariff impact. Can they really offset that full $150 million annualized hit through pricing and supply chain moves without damaging the top line further? That's a huge question mark.
Huge. And third, they're still exposed to the macro environment. High interest rates impacting residential remodeling, or a broader recession causing even essential commercial customers to pause CapEx. Those remain real sensitivities.
And this whole shift, accelerated by transactivism and marked by this massive commitment to buybacks instead of M&A, it feels like a high-stakes bet on focus over their historical growth model.
It absolutely is. They're betting that simplicity and financial discipline will unlock more value for shareholders now than continuing down the path of synergistic but complex diversification.
So, for you listening, what's the key takeaway? The core driver connecting Middleby's very different businesses from fast food to factories is this relentless global push to replace expensive, hard-to-find human labor with efficient, automated equipment.
The spinoff is designed to let both new companies pursue that opportunity more effectively, with tailored strategies and capital structures, to accelerate their technological leadership.
Which leads us to our final provocative thought. These two new, separated companies will now have to stand on their own, competing head-to-head with focused rivals like ITW and others, without the potential, if sometimes hidden, synergies of the old conglomerate.
So the question becomes, will this strategic pivot embracing focus, ditching the M&A engine for massive buybacks, actually make them more competitive in the long run? Or does it trade future technological breadth for a shorter-term valuation pop?
And maybe the biggest question of all, when you finally isolate the business of solving a global labor crisis through automation, packaging it neatly into these two premium industrial stocks, just how much will investors be willing to pay for that capability? That's the value Middleby is betting heavily on unlocking.